Oil embargo of 1973-1974, structural shock, monetary constraint, and the reconfiguration of global power. Introduction: Energy as an instrument of geopolitical coercion. The oil embargo of 1973-1974 represented one of the most decisive demonstrations of how resource control can be transformed into a geopolitical leverage. The embargo was not merely a disruption in commodity markets, it was a systematic shock that exposed the vulnerability of industrial economies of supply concentration and cartel coordination. It revealed the strategic reality that energy flows constitute a foundational layer of modern economic systems, meaning that actors capable of restricting energy supply possesses indirect influence over industrial output, monetary stability, military logistics, and political legitimacy. The embargo demonstrated that power in the international system doesn't solely derive from military superiority or technological advancement, but from control over critical choke points in production networks. This episode marked a shift in geopolitical global bargaining structure. Oil exporting states, particularly those organized under Organization of Arab Petroleum Exporting Countries (OAPEC), recognized that their position in global supply chain could be used to extract political concessions. The realization altered the equilibrium between producers and consumers, replacing the prior asymmetry dominated by Western industrial powers with a more contested structure of interdependence. The embargo transformed oil from a commercial good into a strategic weapon, embedding energy markets within broader geopolitical conflict. Historical context: the Bretton Woods disorder and strategic realignment. The embargo must be analyzed within the broader structure transformation occurring in the early 1970s. The collapse of the Bretton Woods monetary system in 1971 disrupted the stability of exchange rates, weakened the anchor of the US dollar. Under Bretton Woods, the dollar had been convertible into gold at a fixed rate, providing a nominal anchor for global trade settlements. Once convertibility was abandoned, the international monetary system entered a regime of floating exchange rates characterized by volatility and uncertainty. This monetary instability intersected with increasing geopolitical tension in the Middle East. The Yom Kippur War in October 1973 triggered a strategic response by Arab oil producing nations seeking to impose costs on states perceived to support Israel. Following US military aid to Israel, OAPEC implemented production cuts and an embargo on oil exports to the United States and other allies. These supply restrictions drastically altered price dynamics, generating rapid inflationary pressure across energy importing economies. The price of oil increased from approximately $2.90 per barrel before the embargo to $11.65 per barrel by January 1974, representing a clear fourfold increase in nominal terms. The timing of the embargo intensified its macroeconomic consequences. Industrial economies were already experiencing capacity constraints, rising commodity prices, and accelerating wage demands. The oil shock amplified existing inflationary pressures, converting a cyclical inflationary episode into a structural inflationary regime that persisted throughout the decade. The political economy of oil cartels and market power concentration. The oil embargo highlighted the economic logic of cartelization. OPEC's ability to coordinate production decisions allowed member states to internalize the externalities associated with supply restrictions by acting collectively rather than individually. Producers increased their market power and shifted the distribution of rents in their favor. Oil exporting states were able to influence the global price settling mechanisms because alternative production supplies were insufficient to compensate for the production costs imposed by cartel members. The concentration of supply increased the elasticity asymmetry between producers and consumers. Industrial economies had high short-term dependence on petroleum inputs, while oil producers faced relative low margin costs on reducing output. This asymmetry allowed producers to impose price increase without immediate substitution responses from consumers. Infrastructure systems such as transportation, electricity generation, and industrial manufacturing were heavily dependent on petroleum derivatives, creating path dependence with limited rapid adaptation. The emergence of OPEC as a dominant market anchor represented a structural shift in the global economy. Non-OPEC producing nations declined as a share of global output, further strengthening the cartel's influence over pricing decisions. The consolidation of supply control transformed oil into a strategic asset capable of generating long-term geopolitical leverage. Cost push inflation and the limits of monetary policy. The oil embargo contributed significantly to the inflationary environment of the 1970s by increasing input costs across a wide range of industries. Oil functioned as a universal intermediate good, meaning price increases propagated throughout. The oil, em- the oil embargo contributed significantly to the inflationary environment of the 1970s by increasing input costs across a wide range of industries. The dollar and the repricing of energies. The oil crisis were closely linked to changes in the international monetary system because oil was priced in dollars. Fluctuations in the value of dollar directly affected the real income of oil exporting countries. The depreciation of the dollar reduced the purchasing power of oil revenues, incentivizing producers to increase nominal prices to maintain real income levels. Oil producers began referencing gold as a benchmark for value preservation, reflecting declining confidence in the stability of the fiat currency. The value of gold increased substantially during this decade, rising the Bretton Woods benchmark of $35 per ounce, significantly higher levels by the late 1970s. This shift highlighted the interaction between commodity markets and monetary regimes. Energy pricing became embedded within broader debates regarding currency stability, inflationary expectations, and the credibility of monetary authorities. The linkage between oil and dollar valuation reinforced the strategic importance of currency dominance. Control over primary invoicing currency allowed the United States to maintain influence over global trade flows despite experiencing inflationary pressure domestically. The oil crisis therefore didn't displace dollar dominance but instead revealed the structural interdependence between energy markets and monetary hegemony. Strategic consequences, institutional adaptation, and energy security doctrine. The embargo forced industrial economies to reconsider their vulnerability to supply disruptions. Governments introduced policies designed to diversify energy sources, increasing domestic production capacity, and improving energy efficiency. Strategic petroleum reserves were established to mitigate future supply shocks. Investment increased in nuclear energy, coal production, and alternative fuel research. Energy security became institutionalized as a central component of security structure doctrine. Policymakers recognized that supply concentration represented a systematic risk capable of destabilizing economic growth and political stability. The crisis demonstrated that economic systems dependent on a narrow set of inputs are inherently fragile. Industrial economies adopted long term strategies aimed at reducing exposure of cartel power. Technological innovation played a critical role in this process. Improvements in fuel efficiency reduced oil intensity per unit of GDP, weakening the transmission mechanism through which oil prices increase affected inflation. Structural transformation of global power relations. The oil embargo accelerated the redistribution of economic power towards resource-rich states. Oil exporting countries experienced substantial increases in revenue, enabling investment in infrastructure, sovereign wealth funds, and geopolitical influence. The accumulation of financial resources allowed producers to expand their presence in global capital markets, influencing investment flows and development patterns. The distribution of wealth altered the structure of international relations. Resource exporting states gained greater bargaining power in diplomatic negotiations, while energy importing economies sought to secure long term supply contracts through political alliances. Energy diplomacy emerged as a specialized domain within foreign policy strategy. The crisis demonstrated that economic power is not exclusively determined by technological sophistication or industrial capacity. Control over essential output can generate leverage sufficient to influence the strategic behavior of more technologically advanced states. Theoretical implications, supply shocks, and macroeconomic instability. From a theoretical perspective, the oil embargo challenged existing macroeconomic models that emphasized demand management as the primary determinant of inflation. The persistence of stagflation, characterized by simultaneous inflation and unemployment, contradicted traditional Phillips curve, assuming as a correction. The persistence of stagflation, characterized by simultaneous inflation and unemployment, contradicted traditional Phillips curve's assumption regarding the trade-off between inflation and unemployment. The crisis contributed to the development of rational expectations theory and credibility based monetary policy frameworks. Economists began emphasizing the importance of expectation formation in determining inflationary dynamics. Policy credibility became recognized as a central variable influencing macroeconomic outcomes. The oil shock also highlighted the significance of structural constraint in economic models. Models assuming frictionless adjustments failed to account for the rigidity of infrastructure and production networks. The crisis demonstrated that adjustment costs can prolong disequilibrium, generating persistent deviation from theoretical equilibrium conditions. Long-term legacy, energy markets and strategic competition. The legacy of 1973-1974 oil embargo extends beyond its immediate economic consequences. The crisis established a precedent for the use of economic instruments as tools of geopolitical strategy. Control over supply chains remains a central determinant of power in the international system. Subsequent energy crises, including the oil shock of 1978 to 1979, reinforced the perception that commodity markets are embedded within political structures. Energy security continues to shape foreign policy decisions, investment strategies, and technological innovation trajectories. The structural lesson of the embargo is that economic systems organized around efficiency may sacrifice resilience. Dependence on concentrated supply network increases vulnerability to strategic disruption. States seeking long-term stability must balance efficiency gains against the need for redundancy and diversification. Conclusion: oil is a vector of structural power. The oil embargo of 1973 to 1974 demonstrated that control over energy resources can function as a vector of structural power capable of reshaping global economic relationships. The crisis exposed vulnerabilities in industrial economies, accelerated the transformation of monetary frameworks, and altered the distribution of geopolitical influence. The episodes illustrate the interaction between economic structure and political strategy. Supply shocks do not merely affect prices, they alter bargaining positions, redefine institutional priorities, and reshape expectations regarding stability and risk. Energy markets remain embedded within geopolitical competition, ensuring that the strategic implications of the oil embargo continue to influence policy decisions decades after the immediate crisis subsided. The central analytical insight is that power in complex systems often resides not in visible institutions but in the control of foundational inputs upon which those institutions depend. The 1973 to 1974 oil embargo provided empirical confirmation that the economic interdependence doesn't eliminate conflict but instead creates new arenas in which power can be exercised.